Well, the market has exploded in the Treasury. Even though the Fed said they're going to hold, it has exploded this morning. Hey, Joe, how you doing?
You know what? Like, I found some play money in my office randomly. Let's just throw it all away. Like, I don't know. Like, it was interesting morning from yesterday to today. I mean, MBS down 85-ish basis points, 90-ish basis points. The bond market today up 10, 11 on the Treasury. Wow, on the 10-year. I don't know what's going on here.
Yeah, good morning. Brendan Rendo with the Homes in Orlando team, joined as always by Joseph Dion. Please like and subscribe. We were going to come out this morning basically talking about how Jerome Powell, his meeting yesterday, he wasn't never exuberant.
Come on,
but he was.
Powell.
It was Powell. He actually didn't mention any of his tools yesterday, which was cool. Because we on the broadcast I watched, we always count the number of times he says tools. He didn't have any, but the words he was using yesterday, one of the big ones was neutral. What's the neutral rate? What the neutral rate looks like it's going to be higher than we thought. The neutral rate is this. The neutral rate. He kept talking about the neutral rate, and then another thing is someone asked him about the soft landing. And I thought he was going to panic right there. He just pulled back and just kind of like, well, and historically we know the Fed has never had a soft landing.
No.
Ever. What is going to make this time any different?
Well, if you talk about it enough, you're going to will it into existence, right? No, probably not.
No.
Maybe if we talk about it a whole bunch and then we just stop talking about it when we don't have the soft landing, we can placate that it never really was something on the table.
Yeah, it's kind of like, when you got a dispute with someone, you figure, oh, well, if I just shut my mouth, it will go away.
Yeah.
This isn't going away. And it was interesting because he threw a little jab at Yellen yesterday. It's kind of like, bam, out of the side, because someone had asked him about mortgage rates. And he said, well, that's really on the Treasury. Like, oh, is that a little jab?
Like,
and I caught that. I'm like, okay. And I understand exactly what he's saying is basically Treasury, get your house in order. Congress, you're talking about a shutdown again. Get your house in order.
Mm-hmm.
Because since the suspension of the debt ceiling, which was the stupidest thing they've ever done, bunch of idiots.
You know what?
But since the suspension of the debt ceiling, we're going to ring up $3 trillion of debt by the end of December.
Yep.
And it goes back to the same old thing. If you're putting out all this debt, the yields have got to push up.
Mm-hmm.
And I called you Monday morning because Sunday night, between about 8 and 10 o'clock in the Treasury market, there was a anomaly. It was a glitch. A glitch. The 2-year exploded nearly 50 basis points for like 2 hours and then came down back to normal. And the 10 jumped, I believe, was about 0.2 of a point.
Mm-hmm.
And pulled back, and then all of a sudden pulled back within 2 hours. And they're saying, oh, it was a glitch. It was just a glitch. It was a glitch in our system.
Mm-hmm.
Well, I'm wondering if that glitch was the Fed stepping in to hold everything back before the meetings. Because what did we get this morning? Welcome to your 10-year Treasury yield this morning. We went from basically 4.34 to 4.48 in the opening this morning.
In the opening. Bam.
In the opening. Boom.
It was pretty.
You're probably not going to see too many rate sheets initially this morning. I imagine they're going to hold back to see where this market.
They're going to hold back a little. I mean, well, it was interesting yesterday. I mean, we talk about it. You're talking the 30-year. We're down 85 basis points from basically 11:30 a.m. yesterday. 85. Like, we saw a lot of investors reprice multiple times. We saw investors pause pricing. We haven't seen that type of activity in a little bit, so it's kind of, there's a lot of uncertainty. And I think today we're going to see some investors hold back, see where it's going to go, or they're going to price really, really conservative. And the reality is this 10-year at 4.48. What's our next resistance? It's 4.5, which is what? That's a psychological barrier. There's nothing else beyond that. So it's like, what happens if it goes above 4.5?
I think if we push above 4.5, I think we push. I think it pops up to 5 really quick.
Yeah,
I really think it pushes up. And if they're going to continue to put out this additional debt,
mm-hmm.
it has no place to go but there.
Yeah,
it really doesn't. And when we look at this every week, is what are people betting the Fed is going to do? Well,
mm-hmm.
They came out and basically key points were, one, we're probably going to have to do another 1/4 point increase before the end of the year, which means the November or December meeting. Correct. Yep. And then they had expected possibly 4 rate reductions next year, pulled that back to 2.
Yep.
So his summary was rates are going to be higher for longer. So it means get comfortable where rates are, because this is probably where we're going to sit.
Buckle in
for at least a good year and a half. This is where we're going to sit, unless we have that crash instead of the soft landing. If we have the crash, which you're seeing it pull back in all the numbers, I think that's where we are. Because you look at December, and you still got over 50% betting that they're not going to do a rate increase in December.
Yep.
So that tells me that we've got a lot more people looking at the numbers going forward instead of back, saying this economy is, you can say it's strong all you want, but it's not.
Mm-hmm.
It's not. And the effects it's having, the incredible amount of debt, the higher interest rates from the Fed, corporate bankruptcies are up 56% right now from last year.
That's a little bit.
That's a little bit. And the money supply, for the first time in history, or for the first time since the Great Depression, is shrinking again.
Mm-hmm.
So there's a lot of indicators that are not positive at all. And Fannie Mae came out and said the U.S. housing market is headed for the largest slowdown since 2011. They are projecting 4.8 or 4.9 million homes sold next year. That's it. From a peak we had about a year ago of over 6.5 million?
It's a big pullback.
That's a huge pullback.
When you see, and then what else we've got? The builder confidence is down, right?
Yeah. Builder confidence.
National Association of Home Builders, their index down another 5 points for September, reading to 45.
What did you tell me this morning?
Oh, magically, and I don't know about timeline, right? D.R. Horton's CEO steps down yesterday evening.
Right after Powell?
I don't know why. I feel like sometimes things line up very interesting. Obviously, that's probably in the work, but if there was confidence in where building and construction and new build and the housing market and all that stuff, would the CEO be stepping down?
No,
probably not.
Probably not.
Rode
And
the
then I mean,
wave. Now he's
you
like,
can
time to get
kinda
off the
see right
wave.
here in July, this is when builder confidence was up.
Mm-hmm.
Since then, 2 months in a row, we've had builder confidence slide a lot, tremendously. Look at their stock price. Boom. We should have been shorting it, Joe.
Shit, could have been a good time to short it.
Yeah, I think it still may be a good time to short it. But I mean, because they can only buy the rates down for so long.
Yeah.
Because it just gets more and more expensive to try and buy these rates down.
Yep.
And if the rates keep going up, instead of buying it down to where they were buying at 5%, if all of a sudden, okay, now I can only buy it down to 6.5%, those people who could afford it at the 5.5 are going, nah, I can't do it. I just can't do it. It's no different than we have right now in the resale market, where, and we're going to see it in the numbers, is the resale market has really pulled back because people are just looking at going at 7.5. I can't afford it. I mean, we showed the information last week where the average mortgage right now is principal and interest only is $2,300. And then you add taxes, insurance on top of it. You're now saving $3,000 for a mortgage payment.
Mm-hmm.
You've got to have one member in your household work just to pay for your place to live.
Yeah.
And that's just it. Of course, is not sustainable. I think everything's going to build to a crescendo, and it's going to fall. It's just going to fall. You got $1 trillion worth of debt. I mean, here in just over a week, the student loan payments start.
Oh yeah.
With an average student loan payment of $502.
Woo!
That debt comes back onto people. We're going to knock out another good portion of buyers.
Which you mentioned, refinances are going up, right?
Correlation. Yeah, this was the.
I've talked to multiple people that are asking, "Hey Joe, can I do a cash out?" And one of their concerns being brought up is student loan payments resuming.
Mm-hmm. Yeah, and you look at it. Why would demand surge for refinances? One reason right now, when you're going from maybe a 3%, even say 4.5% interest rate to a 7.5 interest rate to pull out money, it's because you're tapped. Yeah. You are tapped out.
Mm-hmm.
And I think that's, you see the resale numbers, and it's amazing how strong the spending has continued, but all that spending is coming from debt.
Mm-hmm.
It's all coming from debt. It's all coming from credit cards.
Yeah.
And credit card companies, you're seeing articles, be ready to be denied your loan. Be ready to be denied your credit card. And they're actually starting to cut people's, and you're seeing it, cut people's limits on their credit cards. Maybe you had 10,000. Well, they just, no, we're going to cut you down to 5.
Mm-hmm.
So it just, like I said, historically, we have never had a soft landing. And I don't see anything projecting out that says that we're going to have, it's going to be any different this time.
Exactly.
There's nothing there. And then, when we hop into our numbers for Orlando, we had mentioned this, that when that spike jumped, we saw the decrease in the number of homes. Mm-hmm. And again, this week, we didn't break the 400 mark in sales, and our inventory increased.
Mm-hmm.
The single family homes. and this is interesting. When we pop down, I just pop right down into this. As of last week, we now have more homes on the market than we did in January. So
They're changing.
we are flipping them. The market is now flipping. The market is going to start flipping. I really believe that. I think we're going to see more price decreases come out. I think you're going to see people have to be less aggressive on their initial listing price if they want to sell. Because if this continues to go up, it changes from a seller's market to a buyer's market.
Yeah.
I mean, I actually go in and I'll look at per zip code, because sometimes it's different in this area, like Altamont Springs right now where I live. There's 1 month of supply on the market. So it's still relatively a strong seller's market. And that's because there's not a lot of listings per se. But then you get out into the Deltona areas where the number of sales the number of listings has increased, and you've now got almost 3 months of inventory. So you're seeing a shift there, where now you're seeing more price decreases come out than you would per se in Altamont Springs. And our days on market is staying right up there. It only moved one day. And you just look at our weekly sales basically since July. There's what, barely, here's one. Did we break the median line, the average line, since July? Pretty much everything else is sitting below.
Yep.
And when you get into the condos are just, since the beginning of August, their sales are on a steady decline. So it just, and look at their inventory.
Increase 22%. Wow.
22% higher than we were in January. And you start looking at some of these ones that are listed, and I understand why they're not selling. There's a condo over here in Altamont, and their HOA association's fees due to the insurance increases has jumped to $650 a month. These units were selling at $230 to $235, and I've seen people now cutting the price to $180 this week on those units.
Wow.
So, the insurance, with what's going on with insurance in Florida, even the property taxes, our market really is shifting quite a bit when you start looking at those numbers. And as a buyer, I know it's tough to swallow the current interest rates when you look at even where they were a year ago. A year ago, we were maybe 6.25%, 6.5%, somewhere in that ballpark.
Yeah, right in that ballpark. Yeah.
Now you're 1.25% higher. So I think this is where it really comes in with the increased inventory, is being able to negotiate and work with your realtor and your lender to position it so that you're not absorbing the whole hit of the new interest rate. And I'm sure you're getting the calls on the buy downs.
Yeah.
How do I structure the buy down? What's the best way to do the buy down? And it looks like right now that 2-year window is about where we're going to be before people are going to be in a position to refinance a mortgage.
Yeah. I think you're kind of right in that semblance. What we're seeing is, What's funny is like we're seeing that window of how quickly we think rates are going to go down. Because remember, what did we think at the start of the year? What were all the experts saying? Rates will be back down in the fives by, I think it was June.
Or just I think then it pushed to like December.
Then it pushed to December. Now it's sometime next year. I mean, I guess if you keep kicking the can down, at some point you'll be right? Yeah. And that's the hard part is like I think that 2-year buy down period. That's really what we're looking at. Will it be sometime before that? Probably, but you want to give yourself a little bit of a window. And it is a huge savings because you're talking on a 2-1 buy down, a $300,000 home or $400,000 home. That's a $400 or $500 savings a month year one.
Mm-hmm.
And then it's like $220, $250 year two.
Yep.
Like that gets that $2,300 mortgage payment, that average, like drop that down to $1,900 feels a lot more palatable. Right. So I think it definitely is. And with inventory increasing, we're going to see more and more sellers willing to give that seller credit to allow for that. And I think really, I would not be shocked if that becomes kind of like the predominant credit that is received over the next, 3 to 4 months.
Yep. And I think you're seeing it in other parts of the country, and we're seeing it in small pockets here. That you're starting to see price decreases, and there just comes a point where it's something's got, one of the two's got to give. Either the interest rate's got to come down, or the pricing's got to come down a little bit in order to absorb that additional cost on one end or the other. And we'll just we just continue to monitor it, and really try and keep everyone informed. Is like this, based on what we're seeing, this is where we tend to see the market going. So, well, thank you all. We appreciate it very much. And again, please like and subscribe and join us next Thursday. And we'll continue to keep you up to date on everything relevant in real estate. Have a wonderful day.